There are so many headlines right now telling you to start investing. Buy gold, save 15% for retirement, but also avoid tech stocks because an AI bubble is about to burst. Which of these headlines are right, and what should you actually do? I've spent almost a decade in banking, and in this video, I'm going to cut through the jargon. I'll give you a tried and tested strategy that works to protect your finances and come out ahead long run. Let's start with part one, the basics. What is investing and why does it matter so much? At its core, investing is just using your money to make more money. That is it. There are two big reasons why you need your money to make more money. Reason one, inflation. Inflation makes your cash lose value over time. Prices rise, but the money in your account just sits there. $1,000 sitting in your account today, in a few years, might only buy you $800 worth of stuff. Doing nothing feels really safe, but it's actually a slow way to lose your money without realizing it. The second reason, investing, is the easiest way to get rich and build real wealth. We live in an economy where owning assets, property, stocks, businesses is rewarded far more than just a salary. Someone who bought a house 20 years ago has seen its value more than double. Stock market, 8 to 10% per year. But salaries, they've barely kept up with inflation. That gap is getting wider every single year. If you want to stop feeling like you're constantly falling behind, stuck in that cycle of earn, spend, you need to understand this and start using it to your advantage. You need to be investing. Let's move on to part two. How does the stock market actually work? Everyone's heard of the stock market, but very few people really understand how it works. When you buy a share, you're literally buying a tiny piece of a company. So if you buy one share of Netflix, you now own a tiny fraction of Netflix, the company. The stock market is basically a marketplace where people trade tiny pieces of thousands of companies. You're basically saying, I believe this company will keep making great products and become more valuable. There are two main ways you make money. The first, the stock price rises and you sell at a profit. You buy Netflix at $100, a few years later, it's worth $150. You sell. That profit is called a capital gain. The second way, dividends. Some companies share their profits with investors on a regular basis. It's basically the company's way of saying, thank you for being a shareholder to keep you invested. Now you're probably thinking, okay, but what do I actually invest in? Do I just pick Netflix? You could, but it's risky. Even the biggest companies can struggle for years or fall out of favor. Remember when everyone had a BlackBerry? If you bought one BlackBerry share for $144 in 2008, that share would be worth just $4.52 today. We all thought BlackBerry was going to be the next big thing. Even if you read every company report and analyze balance sheets every evening, it's incredibly hard to predict. That's why most successful investors don't try to guess winners. Instead, they buy all the big companies at once. Through something called an index fund, a big basket of hundreds or thousands of shares tracking the whole market. For example, the S&P 500 tracks the 500 largest US companies. Apple, Microsoft, Amazon, Google, Tesla, all of them. $100 invested in the S&P 500 in 1996, reinvesting all dividends would be worth $1,764 today. That's a return of over 1,664%, or roughly 10% per year on average over 30 years. If some companies go down, but others go up, you still benefit from the general upward trend of the market. Now you might be thinking, why not just invest in the Magnificent Seven? Apple, Microsoft, Amazon, Google, Meta, Tesla, Nvidia? Looking at the S&P 500 between 1980 and 2020, the biggest companies have changed dramatically over time. Back then, the market was dominated by General Electric, Walmart, ExxonMobil, completely different companies. In the 1960s and 70s, Kodak, Coca-Cola, McDonald's investors thought these would keep growing forever. Then the bubble burst. Kodak's share price fell by more than 90%, gone from dominant to irrelevant. You just don't know which companies will be at the top a decade from now. Nobody does. Something else worth knowing, the US economy has its own uncertainties right now. Trade policies, interest rates, dollar strength. So it may make sense to invest in funds from other parts of the world too, not just the US market. By owning a little bit of everything, you reduce risk and have a really concrete long-term plan. And now let's move on to part 3, how to actually invest. Because now you know what, here's how. Step 1, pick an investment platform. This is just the app or website you'll use to buy your investments. Key things to look for: it's regulated, it's reputable, and it has low fees, because fees eat into returns over time. Before signing up, look at the types of accounts available. Some offer tax-efficient accounts that make a huge difference. In the US, a Roth IRA lets your investments grow completely tax-free. You pay 0 tax on withdrawals in retirement. And if your employer offers a 401k match, take it. That is literally free money you should never leave behind. Step 2, once your account is open, add money, usually via bank transfer or debit card. Simple as that. Step 3, choose your investments. Remember what I said about index funds generally being less risky than individual stocks? Start with global diversified funds. As you learn more, get more nuanced. But start simple and broad. Step 4, and this is the part most people overlook: automation. Set up a monthly automatic investment. $100s, $200s, $500 a month, whatever you can afford, invested automatically without you having to think about it. This is called dollar cost averaging. Some months you buy when prices are high, other months when they're low. Over time, it averages out. And most importantly, you remove the temptation to mess with it. One more thing for US investors: specifically consider tax loss harvesting at year end. Your platform may do this automatically. And if you're choosing between a Roth IRA and a traditional IRA, Roth is generally better if you're younger. You pay tax now, not later. The whole point of automation is this: it removes emotion from the equation. And emotion is the enemy of good investing. Part 4, the million-dollar question. What if it all goes wrong? What if the market crashes? What if it's at an all-time high right now and then it drops? If you've invested in funds rather than picking individual stocks, you're already well protected from the worst outcomes. Diversify not just across funds, but also across assets. That's what protects you when specific sectors struggle. And honestly, the biggest risk for most investors isn't actually the market itself, it's the investor themselves. You see a guy on the news saying a crash is coming. You panic and sell. And the expert turns out to be wrong. Best case, you sold at a profit. Worst case, you sold at a loss, and now it costs more to buy back in. Automating the process stops you from panic selling when things dip or waiting for the right time that never comes. With so much uncertainty right now, tariffs, rate cuts, election uncertainty, staying the course matters more than ever. Here's what history tells us. The US stock market has recovered from every single crash. Every one, without exception. Time in the market beats timing the market. Always has. The investors who panic and leave always come back worse off. The mental shift you need to make: stop thinking in weeks or months. Start thinking in decades. So if you've been thinking about investing but haven't known where to start, I hope this has given you clarity. We covered 4 things today: why investing matters, how the stock market works, how to actually start, and what to do when things get scary. And I promise no boring investment jargon, no overwhelming numbers, just a clear plan to get your money working for you. Your action step this week: open a brokerage account. Even if you don't invest yet, Just open the account. In the US, platforms like Fidelity, Schwab, or Vanguard are all free to open and highly regulated. And you don't need thousands to start. Many platforms let you invest with as little as $1. Start small, start now. The best time to start investing was 20 years ago. The second best time is right now, today, not next month. Thank you so much for watching. If this helped you, please hit like. It genuinely helps more people find this. And drop a comment below, where are you in your investing journey? Just starting or already on your way? Subscribe if you haven't already. We post practical personal finance content every single week. I'll see you in the next one.